What's up, Macro Optics? Welcome to the daily macro update for Thursday, September 11th. Taking a look at some of the headlines today. Actually, before I get into that, I'm on the road right now, which is why I have my camera off. I'm actually in an airport currently. So, let me know if you guys can hear me okay. Put a 1 in the chat if you can hear my voice good, and if you can see my screen, and we'll get right into it here. A little bit of a crazy 24 hours that we've just had for people who are in the United States. Rest in peace, Charlie Kirk. All right, looks like the audio is working well. Perfect. All right. So, interestingly, after we received the CPI report today, it did have another acceleration for a headline to 2.9%. That was pretty much in line with what we were thinking about when looking at the Cleveland Fed inflation nowcast, right? It's actually above expectations just a little bit for them, but they do have it remaining at 2.9% heading into September. Actually, this is from yesterday. Let me refresh this page. Okay, so now they have headline accelerating to 3.0%. So this is quite the change from where we were at just 2 months ago. So it's very interesting seeing inflation expectations rise as well as the hard numbers. And the Fed is going to cut rates into this. This is basically them showing that they are squarely focused on the labor market, which we've covered in the past couple of videos, how there are sectors or there are points in the labor market that you can argue that it's not completely getting out of control yet. It's definitely a very tight labor market. Again, apologize for the noise in the background here. But yeah, the market is pretty much just saying that this inflation acceleration is extremely temporary, and they don't expect this to continue on throughout the latter half of the fourth quarter in the United States. So this comes after jobless claims had a large acceleration. Continuous jobless claims remain elevated, and then obviously we had producer prices yesterday fall as well. So with all those different things, I think that the market is liking its and producer prices typically front run consumer prices. So that's probably what the market is also pricing into as well. Taking a look at the target rate probabilities for next week's Fed meeting on September 17th. Right now, there's nearly a 93% chance that they're going to cut rates by 25 basis points, as well as nearly or a 7% chance that they're cutting by 50 basis points. So between now and then, there isn't too much of a crazy amount of data, right? So if we take a look at next week, we have retail sales, and that's pretty much the largest one, as well as Empire Fed Manufacturing Index. But really, yesterday and today were the two big reports, and we'll see what happens from here. I mean, what's interesting is if you take a look at the 10-year U.S. government bond yield, this had a very large deceleration today, and right now the 10-year bond yield, which as I've mentioned before in previous videos, if I was looking at one chart only, it would be this chart right here. And this continues to decline, and it broke through its 4.2% level here, right? So it broke through that stagflationary ping pong, and it's at its lowest level since we saw back during that crash back at the beginning of April there. And so this is happening at the same time as the 2-year bond yield is also in bearish trend, but it's not falling as fast. And so what you're actually getting in terms of the yield curve is a reflattening of the yield curve here, right? So if we take a look at the yield curve performance over the past one month, you've seen what's called a bull flattening, meaning that the long end of the curve is dropping faster than the short end of the curve, and that's typically a sign of the bond market pricing and economic weakness, whether that's from growth or inflation. We've already been getting plenty of signals that inflation is, or that growth is slowing. So this is the bond market signaling that inflation, it's expecting inflation to continue to slow from here. So that is definitely interesting there. All right, taking a look at the S&P 500 here. Go ahead and scroll down. Been a little bit sick the past couple days as well, so apologize if the voice is raspy. All right, so we got about 10 minutes left in the markets. The S&P is continuing to push higher than its top end of the trading range zone here. And so, you know, we've been raising cash all throughout this area here. We'll continue to raise cash even more. Everything is incremental. Just because you're selling something doesn't mean that you have to totally get out of the position. So these are just great times to raise some cash as we get ready for the next price drop here. Someone asks, do you think we're heading for a soft landing or a hard landing? Well, it really just depends on how we get out of this from here, right? What you would really want to see for a soft landing is you would want to see growth start to stabilize while inflation comes down, right? If you actually see a very organic and natural pickup in services as well as manufacturing, while at the same time you have the labor market getting less weak, and at the same time you also have inflation coming down. Oh man, like that would absolutely just push stocks to crazier levels, and as well as, you know, Bitcoin, all those things, and that would be a soft landing, right? But we currently are not seeing growth rebound, and we're currently not seeing the labor market strengthen. So I think what the market is pricing in right now is perfection of that soft landing. And if you just look at the probabilities, you know, typically a period of optimism, soft landing happens before it goes into a hard landing. So I don't know when that's going to happen. I'm not trying to predict if or when a hard landing is happening. I'm going to just play to what the market is signaling, which right now it's signaling more of a Goldilocks type of scenario. And so that's how I'm going to position myself for right now until I get further signals from the market. And again, this could take months or even this time next year before we see any type of signals. So, so yeah, I mean, you just have to remember that all soft landings are before hard landings, right? It feels like it won't happen for all those stars to be aligned. Yeah, I mean, anything could happen, you know. But the point is to not to try and predict what these large macro events are going to do, because it's a very slow, very large moving ship that's turning, and so it just takes a while for these things to materialize. But in the meantime, you don't want to miss out on these different moves, if that makes sense. All right, well, that was a great question. What's interesting is that what is performing the best is small cap stocks, right? So that is very interesting. Having a little bit of a correction on Apple. I was buying some Berkshire the other day. That's having a nice little pop there. Let's see here. Best performing sector today is consumer discretionary. Financials, look at that. Financials went right to the top end of the trading range. XLC Communications. Oh wow, actually materials. Very large candle here. That's pretty interesting. Central bank liquidity remains flat. Let's take a look at Bitcoin here. Bitcoin having a nice little pop, getting close to the top end of the trading range. Ethereum looks like it's about to have its next leg up here. Bitcoin miners just cannot be stopped. Also, want to give you guys a quick sneak peek of the new website here. Check it out. Still working on some of the kinks here, but this is what the new Macro Optics website is going to be looking like. Got a nice amount of stuff in here for you guys, so looking forward for this to be launched, hopefully in the next couple weeks here. All right, let's take a look at some of the other comments. Bitcoin dominance remains bearish, so if you're looking for opportunities in the crypto space, it would be more so in the DeFi sector. If you compare Bitcoin dominance to DeFi dominance, I mean, it's pretty easy to see this opposite correlation here. So it's DeFi season right now for the cryptocurrency markets. Gold finally starting to have a little bit of a slowdown from its pop. Silver looks like it's about to continue higher as well. The VIX is at extremely low levels, so take profits on things that are up. And the dollar back to bearish trend. The 5-year break-even inflation rate has definitely been coming down, but it needs to come down more. What's interesting is that when you take a look at the break-even inflation rate from early April of this year, when we had that crash, this was at 2.14, and even though we see the 10-year bond yield at similar levels where it was at the beginning of April, when you look at the 5-year break-even inflation rate, it remains elevated. So, this is telling me that I still don't think that we're going to get down to that 2% goal that the Fed's trying to achieve, probably for the next few years. But we might just be bouncing around between this, 2.9, 2.4% range for quite some time. Which, I mean, looks like the market can can do well in this environment. So, all right, well, that's pretty much all I wanted to come on here and talk to you guys about. There hasn't really been too much macro updates this week, except for the inflation update. We're going to continue to see inflation remain sticky, but we could start to see it come down. I'm really looking at that 5-year inflation rate right here, as well as the 10-year U.S. government bond yield. So, as the 10-year starts to come down, that's where you'll actually see the 30-year fixed mortgages start to come down as well, which, that's a clear break right there. This means to be long, the long end, or the long and short end of the curve, SHY, IEF, and TLT. Take a look at that breakout with TLT. Right to the top end of the trading range. Probably would not, I would wait to get an opportunity at the low end of the trading range, but this is a bullish breakout for TLT, meaning a bearish breakdown for the long end of the curve. So very interesting there. But yeah, appreciate everyone for joining here. As always, if you guys have any questions, leave those in the comments below. Good luck out there, and we will catch you in tomorrow's daily macro update. Bye.